Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Back to the channel. Before we dive into tomorrow's watch list, let's do a quick recap of last week's market and dive into the recent jobs report and discuss 3 key takeaways that are shaping the current economic landscape. But before we begin, don't forget to subscribe and hit the like button to support our channel. Your engagement is greatly appreciated and helps us continue creating informative content. Now, let's get started. Last week, the market closed the books on May and unveiled the latest reading on the jobs market. While the S&P 500 saw a modest 0.4% increase for the month, the employment data presented a more mixed picture with signs of softening becoming apparent. It's important to note that the labor market remains in healthy shape, with unemployment only slightly up from its lowest point this year. However, the May employment figures indicate that the jobs market will exert a slightly softer influence on the economy going forward. Before we dive into the takeaways, let's provide some context. The labor market has been in a remarkably healthy state, with unemployment hovering around historic lows. In fact, the current unemployment rate of 3.7% is only slightly up from this year's low of 3.4%, a rate that hasn't been seen since 1953. However, the May employment figures indicate that we may see a slight shift in the job market dynamics going forward. Now, let's move on to our first takeaway. Takeaway 1. The labor market's best days may be behind it. Despite May's strong payroll report, which showed the addition of 339,000 new payrolls, nearly double the consensus expectations, experts believe that the extreme tightness in employment conditions will likely loosen in the coming months. While this stellar jobs market isn't heading for retirement just yet, it's expected to gradually slow down as the year progresses. This shift signifies an inflection point in the labor market, transitioning from a sprint to a brisk walk. Interestingly, job growth in May picked up pace, defying expectations of a slowing economic backdrop. However, it's important to note that this growth is projected to taper off gradually throughout the year. The unemployment rate, which rose to 3.7% in May, marked the 16th consecutive month below 4%. This streak is the longest since the 27-month period between 1967 and 1970. Nonetheless, the simultaneous increase in the unemployment rate alongside strong payroll gains emphasizes the labor market's inflection point. Takeaway 2. Wage pain is the Fed's gain. As the labor market softens, slower wage growth emerges as a silver lining. This slowdown in wages is expected to contribute to a decline in inflation over the remainder of the year, easing the pressure on the Federal Reserve to continue raising interest rates. In recent years, tight labor conditions have driven above-average wage growth, with average hourly earnings rising at a year-over-year rate of 4.9% in the last 24 months compared to 2.7% over the previous decade. However, wage growth moderated in May, clocking in at a pace of 4.3%, the slowest since June 2021. Additionally, the rate of employees quitting their jobs, a key indicator of wage gains, has declined recently. This decline suggests that wage growth may further moderate in the near future. While moderating wages may not be a trend to celebrate, it is a necessary condition to alleviate inflationary pressures. The decline in wage growth last month suggests that the upward pressure on consumer price inflation may ease. While moderating wages may not be an ideal trend, it is a necessary condition to alleviate inflationary concerns. The slower wage growth, combined with the strength in monthly payroll gains, adds support to the case for the Federal Reserve to pause on rate hikes. However, the ongoing strength in the labor market creates some complexity in the overall picture. The consumer sector remains resilient despite the broader economic slowdown. Household spending has remained robust, thanks to the strength of the labor market. Although the strength is expected to fade somewhat in the coming months, consumers are still well positioned to weather a slowdown with fewer negative impacts compared to a traditional recession. In terms of market performance, a late-week rally was driven by a resolution of the debt ceiling issue and a positive interpretation of the jobs report. The market found comfort in the strong hiring growth accompanied by a moderation in wage growth, indicating a soft landing for the economy. Small-cap stocks outperformed, signaling optimism for the economic outlook. Looking ahead, there are a few key factors to consider in the market. Firstly, the Federal Reserve's quiet period will begin, during which policymakers refrain from making public comments ahead of their rate announcement. This period often leads to a decrease in market volatility as investors await the Fed's decision on interest rates. In addition, the recent resolution of the debt ceiling issue and the signed deal to raise the nation's borrowing limit provide some relief to the market. This development alleviates concerns of a potential government shutdown and default, which could have had significant negative impacts on investor sentiment. Turning to specific stocks, Advanced Micro Devices, AMD, is worth noting. The stock recently experienced a pullback after a strong run-up towards its highs. If you are considering a short position on AMD, you are looking for the stock to decline below the $116 level. It's important to conduct thorough analysis and consider various indicators before making any investment decisions. Another stock to keep an eye on is GameStop, GME, which is set to release its earnings report this week. Given the history of Wall Street Bets community's influence on GME's stock price, there is a possibility that the subreddit's activity and discussions could impact the stock leading up to the earnings announcement. It's worth monitoring the situation closely to see if there is any increased attention or potential pumping of the stock. Overall, despite the unexpected increase in the unemployment rate, the labor market remains strong and resilient. The Fed's decision on interest rates will be influenced by the evolving economic data, and while a rate hike in the second half of the year cannot be ruled out, the central bank is expected to be cautious in easing monetary policy. As always, it's important to conduct your own research, stay informed about market developments, and consider your risk tolerance before making any investment decisions. Market conditions can change rapidly, so staying vigilant and adapting your strategy accordingly is crucial.